coming back to the second part of the seminar. We'll now have a panel discussion with our four distinguished guests. And I'm going to start with Reggie, because that's still fresh in my mind. You paint a very somber picture of the potential scenarios in Europe and the European real estate sector. Is there any way we can avoid in Europe a Japanese situation?
Well, in my opinion, is my mic on? Can you hear me? Yeah. Okay. That's a very general question, such as we and avoid. I think in general, in terms of economic cycles and balance sheet recessions, the best way to avoid it is to moderate the boom. So you have to smooth out the cycle. That's out of the reach of individual investors or even large investors. But from a policy perspective, the best way to avoid it is to prick the bubble as it's being blown. Of course, it's very difficult to predict the future, but when you start running numbers and 2 + 2 = 15, there should be a hint that things are getting a little out of hand. As it is now, I think it's policy to try and reinflate the bubble after it bursts, which is damaging and distorting, versus pricking the bubble as it's inflating. As for a more practical perspective, from an investment point of view, one of the earlier guests got it right, location, location, location. If you have a valuable property, that valuable property is going to be yeah, I see. We're all family, I guess. Okay, now I'm smiling. So if you have a valuable property, you have a valuable asset. And if ran correctly, I think it should last through any cycle. I think there's also a lot of opportunity for astute and aggressive cash flow investors who are looking for deep, in-the-money purchases. Again, cycles go up and down, and from a market psychology perspective, usually in the bull market, and this is a bull market in all assets, people get carried away in the optimism. In a bearish market, they get carried away in the pessimism. So if you can find those gems and you can vary them properly and step in, I think there's a lot of opportunity from a cash flow perspective and the ability to diversify. We're going to be, in my opinion, in a long-term bear market, but there's still cash flow to be had because people still have to live, you still have to rent office properties, et cetera. From the United States perspective, I'm much more bearish on retail property because the entire paradigm is changing with the advent of the web and the amount of discretionary income available. But that's a discussion in and of itself.
Okay.
Okay, I tend to be verbose, but hopefully I answered your question.
Yeah, okay. But what about other effects that I haven't seen you mention in this in your presentation, like the increasing globalization, capital flows new capital flows from Asia. I mean, these are also the world's changing very rapidly, and these are also going to have effects. I mean,
I touched on it briefly in terms of correlations. In school and at university, you're taught asset diversification. In order for asset diversification to work, you have to seek assets that are not tightly correlated. When you have a significant movement, especially globally, there's really no diversification. And you see equity volatility and yield volatility tends to run lockstep. I am not as bullish on China as many other pundits are because I believe that China packed 25 or 30 years of growth within 3 or 4 years. That's difficult to do without paying the price, paying the piper. After the inflation or the bubble is either pricked and they have a soft landing or they have a hard landing or a crash, I think China has a lot of potential. So China can be the source of contagion and that correlation going back into the Eurozone, the EU, and the US, and vice versa. Right now, China is actually importing inflation into the US because of wage inflation, and their lower cost products are driving up prices. This is driving up prices in the US, and it's hurting the retail market, in a nutshell. So that's a very, very deep conversation because you go on the currency exchange rates, et cetera. But the overarching theme is that we've had a very long bull run. In the U.S., you had a 32-year interest rate bull run, culminated in a very big bubble. And in the EU, you've had the opportunity, not necessarily the event, but the opportunity for profligate spending from a sovereign perspective. And again, you can't do that for so long before you pay the piper. And now it's time to pay the piper, and the events are unfolding.
Okay, the events are unfolding. Jacques and Tom, from your perspective, I mean, bringing it back to the Dutch situation, Reggie has painted a very sombre picture, as we've heard, stagflation, potentially down the road for an extended period. How is this going to affect real estate in Holland? Jacques, yeah.
Well, I think it depends very much on the type of category we're talking about. Some real estate categories will be quite vulnerable. And we know those categories quite well. Those are the office markets. On monofunctional areas and areas where there's decline of population, this will affect also the retail market and of course the residential areas. But there are still a lot of opportunities. And I think within these opportunities, it is possible to have this hedge of inflation and to have a good return with on acceptable risk levels, still also in the near future.
I'm a bit somber, I think. I think the investors, the developers, and valuators are covering each back right at this moment, and they are all aiming for deflating the bubble. And they are all aiming for deflating the bubble in a very careful manner, very softly. But a big burst, I don't know if it's going to come in the near future. I think there will be still great demand for prime real estate, but at lower in-step levels and lower values. So I'm quite somber, I think.
Mm-hmm. Okay. Jacques, you mentioned in your presentation that the Dutch real estate sector hasn't seen the sharp falls that we saw in the UK and the US, but you intimated that there may be a change.
There may be. Again, some categories are quite vulnerable. When you look at the non-listed real estate funds, mostly in office spaces. Well, they bought a lot of those offices 6-7 years ago, and normally they have a duration period of about 6-7 years. So there is an expiration moment now. So that could be a problem. And the same is for big portfolios in the Netherlands, financed by Irish, American, English equity organizations, also lenders, of course, normal lenders, which has been structured with derivatives, the mortgage-backed securities. So there will be those mechanisms working when there are breaches of governance. And we're talking about a few billion of euros here in the Netherlands. So there are two things possible, in my opinion. First, it's possible that there will be an increase of foreclosures, forced sales. But the other possibility, and it can be both together, is that private equity organizations are standing at the sideline right now, trying to buy these debt with a certain discount and try to make opportunities because of the price levels are that low that there are opportunities to optimize the cash flows and to earn money by selling out in a proper way. But then we're talking about discounts. Mm-hmm. So for those categories and those sectors, there might be a risk, yeah.
Okay,
and still has to be a contract for the building, which generates cash flows, and someone who's willing to invest in those buildings with a contract. If there's no contract for a building, it's over. And I think inflation hedging, okay, but only for contracts that have still a duration. But when the contract is over, then the values are going to drop.
Well, I think that's true. There will be a drop of value, and we already have dropped quite a lot of values. There are some real estate types which has been considered as a hopeless already 12 months ago. But I think that in general there will be a sort of reset in the market when price levels are that low that there are becoming new opportunities for speculators and for developers. But in that case, it's necessary to change zoning plans and to find alternative uses. The starting point of those types of real estate should be quite low.
Okay, you said that the market might reset. You're talking about discounts. Can you give us an idea of what sort of discounts you...
Right, that's not very easy, of course, but as I said, the office market, but also light industrial with multi-let complexes with, on average, 2-3 years of average lease terms. Those are quite vulnerable, also because of this last category, that the tenants are depending on also the financing of the banks. But when you look at retail, right now it's not very popular to invest in subprime retail, the B and C locations. But in my opinion, it's more easily to change the functions and to find alternative uses for those areas, for those types of real estate, because it's in the city. And there are more possibilities than compared to the office objects in monofunctional areas where there are not a lot of alternatives.
Okay. You've said before in our discussions that the Dutch real estate sector has been relatively cushioned by the large number of private investors. And I think Reggie has mentioned the trigger. You know, the ECB has raised its interest rate yesterday. Is that the trigger that we're all waiting for, some of us, to see further devaluations?
Yeah, maybe. Yeah, I think that the financial structure and the banks have a negative influence in this market and can indeed accelerate this tendency. But as a matter of fact, I think that the real estate market for investors could be dull for the coming 5 years maybe, because the fact that banks are not willing to provide a fund anymore easily.
Mm-hmm. Okay, which brings me to Leo.
Yeah.
Okay.
You're talking about banks.
Okay, what will you finance? You will finance quality real estate.
Yeah.
You've given some indications that you're interested in financing sustainable real estate. What exactly do you mean by that?
Well, I would mean by that it's standing investments, so it's existing buildings. It could be energy labels, whereby
buildings with energy labels.
Yes,
yeah.
yes, of course, and what we call in Holland BREEAM certificates.
Mm-hmm.
I think that's important, and that one has to comply with these standards, or otherwise you could see an increase in interest rates, something like that.
Mm-hmm.
Or otherwise, for new buildings, we don't finance at all.
Yeah. Okay, that's a clear message. Do you see your approach to financing sustainable buildings? Are you rewarding sustainable buildings, or are you penalising unsustainable buildings?
No, it has to be a mix of the two. And on the other hand, sustainable building is still starting up. So I think we just have to facilitate it as being a bank by subsidizing is not the right word, but perhaps in interest rates or the leverage itself be more competitive.
Mm-hmm. Okay.
So penalizing is not the right thing at this moment.
Okay, but I think it was Jacques who said that green buildings don't necessarily generate more cash flow. So.
No, I was not mentioning it. I said that green buildings are not valued, are not priced in the market right now in a way a green building earns, in my opinion.
Okay.
So I think in the long run there will be a better cash flow in those buildings.
Okay.
But in the near future there won't be any demand from the Dutch government and not from the individuals and the private companies. So I think demand will stay very low for the next 2 or 3 years. When we look at interest rates, they will come up. The EU Bureau of Statistics think that the interest rates will go up to 4%. So it isn't all quite good for the near future for Dutch real estate. And we see, of course, that there isn't much demand for office space anymore, and it will decline in the near future. So quite somber.
Yeah. Okay.
You
think this is correct?
Well, given the accuracy of the EU statistics, 4% probably means more like 7.3. But yeah.
They predict 1% growth for demand from the public governments. So.
Okay, Reggie, how do you look at the Dutch real estate? We've seen some of the figures here, which you don't believe. Can you prick through some of the figures that your colleagues here have presented today?
I can. My colleagues probably have me trumped in terms of local knowledge of the Dutch real estate. I have looked at a lot of the research reports in preparation of coming here. I noticed that ING is significantly more bearish on their almost all economic projections in comparison to the IMF, which would lead me to believe that the ING is probably a bit more accurate if you look at the IMF's track record in comparison to the EU. But again, like I said, human behavior hasn't changed, and we're on a troll. We're on an economic low. What a lot of people thought. A lot of people ask me, so do you think the recovery is going to end, or do you think that the bus is going to come back? And again, it's a misnomer. I don't think the recovery started. A true recovery is when you have economic activity that increases on its own. What central bankers and governments are doing is they're buying a recovery, and that's not a recovery. If I have to give you $1 in order for you to loan me $1, then you're not a viable lender. You're simply recycling that same dollar. When you can loan me $1 and I can pay back with $1.10 debt service and interest, then you have a recovery. And I haven't seen prolonged evidence of that as of yet.
Okay, okay. Let's just go back to the Dutch situation and the unsustainable or lots of vacancies. Amsterdam is, we've seen all the figures. Leo, what do you think of the plans of the Mayor of Amsterdam to force project developers to obtain new land plots on the Zuidas?
Yes.
When they've got the land plots that they have to solve a vacancy problem elsewhere? Will that help solve the vacancy problem?
It could, but apart from elsewhere, I would also suggest to look at the Zuidas itself because of the vacancy rate. So I think it's a good starting point. I mentioned it in my presentation. Permits given by municipalities should be restricted in concern of considering vacancies in certain areas. Yeah,
okay. And if you were to finance a building at this moment, would you prefer a building with a single tenant and a lease contract for 5 to 7 years, or a multi-tenant building where the average lease is, say, 3 years?
Depends on the quality of the tenant. If the single tenant is A-rated, I would go for a single tenant and a longer duration.
Okay, okay, okay. That's interesting. So, okay. Let's see if I can. Move the. Okay. Okay. Going back to the valuation discussion, there seems to be quite a gap at this moment between the expectations of buyers and sellers in the market. The buyers are waiting for vendors to drop their prices. When do you think? Yeah, sorry, this is a. Okay, we're going to go back to valuation again.
Well, I can maybe answer a part of your question, because I think that regarding also the policy of the local government, we must not forget that the local governments in the Netherlands are one of the biggest influences of the supply of offices and also warehouses. Of course, everybody has part in the situation we are, developers, investors, But in the Netherlands, it's one of the most important earning models of the government to sell out building sites. They had about 25 to 35% of their yearly budget was based on selling out sites. So, and now trying to get it back by trying to let owners demolish their property, or maybe developers, I think that's quite weird to use this policy. I think that the owners of buildings will face this loss and will accept this loss now or in the near future, because everything is cash driven. So there will be a turning point if there is structural vacancy in those areas.
Okay, Tom, do you agree?
Well, I think in the first place it is a business risk when you invest in a building, and when there is still not a lease contract, then you have to face the loss. And that's in the first place. Secondly, I think the Dutch local governments are facing business risk too, and now at the moment, because a lot of buildings are going to grow obsolete, and there will be big problems with security. You can use the film for that. You saw it in the film. So in the end, it will be a business risk for the local governments too. And so I don't see really the problem of getting some money back from the new investors for old sites to polish them up a little bit. But I have a huge problem with how to divide the money amongst the old sites and old building owners. And I don't see a real solution for that problem. How to do that?
Okay. Yeah. So it's the vacancy problem in Holland. I think Leo intimated as well that that you have a moral obligation to
More or less.
Yeah. Okay. Okay. Can we say that if you look at the vacancy, I mean, there's is it in maybe some way good for the market as it sifts the good from the bad?
No, I don't think vacancy is good at all. Not at all. So the answer is no.
Okay. All right. What about the incentives? I mean, we're seeing more incentives in areas where there's high vacancy levels. I think Shaka mentioned up to 20 to 30% of rental flows were going to incentives in some areas. How do you value that?
Well, it's part of the cash flow. It's part of your model, because it's part of the income. So we can model that, and we will model that. So when it's about an extension of the lease, you have to take care and think very carefully about what the market sentiment will be in that time, from the perspective of the market, of course. That's our starting point. And nowadays we know that there is this incentives, and we don't see any improvements of offices the coming years. So we will incorporate these incentives into the cash flow.
And that's always very clear in the models?
No.
That it's, no.
Oh, in the models? Well, depends on the valuer. I think it should be clear.
Okay, but it's not always clear in the market what's happening.
No, it's totally not clear in the market.
No.
You have to be a market maker, you have to be an agent to know what the incentives are, because this is not disclosed in the market.
Okay.
It tends to be window dressing. For example, in the office market, square meter prices will be the same. And on the other hand, free periods for rent of 12 months will be given. But what you see isn't what you get. What you see is 180 a square meter. And if you model it the right way, it will be 150, something like that.
But the incentives are just an instrument to average out the future cash streams, cash flows. And that's not only for real estate, it's in all sectors. It's quite usual for decades long to do that. But it is a very important input factor in your model.
Yes, but we can model it all. There's no problem at all. But The proof of the pudding is, of course, when the building is sold and we know the price. Then we know what's correct.
I agree.
Okay, and this is all, I mean, these are all factors that make the market more intransparent, difficult to judge.
It isn't disclosed.
It's not disclosed, which is also what you, Tom, were talking
Yeah.
about. The role of the valuer is changing.
Yeah.
He has to become more like Oscar Wilde, has to write more. Is that something, can you react to that, Jacques, the future role of the valuer? How do you see that?
Well, it's getting more and more professional. There are a lot of regulations you have to meet, like the IFRS and all the valuation standards, BREEAM, sustainability rules. So professionalism and to find good foundations and comparables is very important. Independency is very important. You said it. A valuer is not the one who does the transaction. So independency, education, all these things will become better and better. It's more important now and in the future, I think.
Okay. Just going to go back to Reggie for 1 minute before I ask the audience if they have any questions. Reggie, you mentioned that you're developing with your team some macro options targeting the European market.
Targeting the global market.
Global market.
One of the advantages is that it allows you to gain exposure or hedge across geographic borders. So let's suppose you're an investor or a bank and you have exposure in Japan, Tokyo, Amsterdam, New York City, and Lisbon. You can use a model to create an option custom tailored to your particular portfolio. And then you can hedge your risk by selling off risk to an investor, or you can buy risk or put on that particular portfolio or any portfolio of your choosing. You know, it's customizable. And it's unique. I think this is a very opportune time for something like a product like macro options, because I believe, as you said, I'm not necessarily bullish on interest rates in real estate for the short term, but not everybody agrees with me, and I could be wrong. Again, like I've been saying, I was wrong back in 1982 once. Okay. So there's always two sides to every trade, and that is a way of transferring risk without going through the effort of transferring an actual asset itself.
Okay. But okay, there are two sides to every trade, but if you look at derivatives in Europe, it hasn't really taken off. And you know that one of the criticisms has been that it's too much of a one-way street, one-way view.
I have to step very carefully, and normally when I speak freely and I step on a lot of toes. So one reason why derivatives either haven't taken off in a certain area or have taken off, like in the US, and then have blown up, is because the vendors of said derivatives are actual principals and not solely agents. So if I'm selling a derivative, but I have exposure to a particular asset, there's a conflict of interest there. And there's a reason for the derivative not to take off, or for there to be some, not mistrust, but suspicion. If I simply take a product and say, you have a problem or you want to get rid of X and he wants to buy X, and I simply assist in the transaction, then that should be clean, and there should be no reason for that to take off. In addition, a slight, and respectable correction, derivatives are available everywhere. Remember, the dollar was a derivative. The dollar was based upon gold. You have plain vanilla traded options, which are very popular in Europe. Mortgage-backed securities. The sovereign derivatives based upon sovereign bonds. So derivatives that serve a purpose, that don't put the principal potentially in a position of conflict of interest.
Real estate derivatives.
Right, real estate. Well, again, and real estate derivatives, I'm not very familiar with why they didn't take off, but as a potential user or investor, I would be very wary of a real estate derivative, buying it from an entity that has a potential conflict, such as being a principal, either owning a portfolio or having clients who own a portfolio.
Okay. Okay.
What kind of risks do those options cover? Do they cover mismatches in price and values?
The macro options are custom design, and the ones that we've developed to this point cover the risks that I illustrated in the presentation. If you have a specific risk that you could delineate, we could run the data and we could create an option for that particular risk. You just have to understand that there has to be somebody at the other side of the transaction who either has to offset or purchase said risk. So